What is going on, everybody, and welcome to another weekly update. And in these videos, what I like to do is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing, as I do provide daily update as well at Hemi137. Give you the daily pulse of the market, and from time to time, I do jump on here and provide additional videos on current events. So, with that being said, remember to hit the like button because it helps the algorithms and because you also love these videos as always. But nonetheless, let me quit tooting my own horn here and go ahead and get started. So I have essentially talked about this all last year coming into this year. It is going to be important. Obviously, earnings are always an important part of the cycle, but more so given now because a lot of times the news is essentially been pushed off. Any big news has been pushed off to earnings. And I talked about coming into this earnings that this earnings is going to be very, very pivotal as we are kind of aiming for March and why the importance of March and that March 20th monetary policy. Will they be cutting? Now, there's a lot of speculation on if it's going to happen or if it's not going to happen because of the fact that we've had numbers that are reflecting that essentially job data, which is really good. And something I talked about last week, it is not good. It's a lot of part-time work and losing tons of full-time jobs. It's very hard to find adequate, essentially, talent out there because a lot of people are doing other things. And so, with that being said, um, we're getting very skewed numbers in a lot of ways, but people are still believing that there will be a cut in March. I'm still leaning towards, I think the best opportunity for them to cut would be in March. That is the next move. If we want a big move to the downside, we need the cut to price in a recession. But I will say this again, none of this is financial advice. But this is the dip I've been talking about for a long time. Is that once this is cut in, once the recession is priced in, even if we make a new low or not, you want to be buying this dip because after that, the money printer is going to be turned back on and we will start pushing back up at that point. I think we will be in recovery mode from that point. How long that takes, again, the stock market will move a lot faster than the economy will. I do believe housing and automobiles will still be affected. Automobiles will recover a little bit quicker than housing, but I think housing still has a way for their correction to happen. So, again, I think the stock market move will be um, hopefully this year. We don't know. There's nothing is guaranteed. We try to time it last year, and it just wasn't working out. So this year, this is why we go. We don't, try to think too far ahead. We got probably a quarter ahead is probably good enough. Anything past that, I think a lot of times even a quarter ahead is too far ahead to be thinking, as things can change a lot very quickly. So that's why I do weeklies, and ultimately understand on the daily it changes a lot. News can drop, and we are in that time right now as we are starting off earnings, and we had some big bank earnings as well, which I didn't actually put on here because we've had other big news this week as well. But I'll go ahead and dive into, since I didn't mention the banking earnings on here in the weekly recap. Just going to talk about those a lot. Again, expectations are very low. Something I mentioned too last week is that there's a lot of unrealized losses just because these banks are hitting expectations. They're unrealized losses. I mean, billions of dollars unrealized losses, right? If that's not brought to the market, you're not going to be aware of what's going on. But yet these companies are doing very well. And so it doesn't matter so much when it comes to big banks, but which banks are quite interesting when I get into this next point here as well. But um, they're going to be holding the money a lot. They're going to be holding a lot of essential, people's savings accounts, checking accounts, and so obviously they're going to do really well, especially after when the crisis started, the banking crisis started last year. They've been doing extremely well, but yet what we're still seeing and why you can't go off those numbers is because of the fact that they're still closing branches. A lot of your Big Ten banks are still closing branches because they are reducing risk. Just because expectations are so good, there's tons of layoffs. We're seeing more bank layoffs. We're also seeing more. Um, tech layoffs as well. I talked about Google last week, and this week we had Citibank just cut a bunch of people as well. See massive layoffs across the board. As long as rates continue to remain high, there will be more and more layoffs. So they've tried to do a lot of these companies try to do the best that they could to hold on to people, but again, you have to understand it gets to a point to where expenses are just so high that they don't have a choice but to cut, right? And even being said, we also do have the core this week as well. So just to try to wrap up the banks, so we had JPM, we had Citibank, we had Wells Fargo. All of those pretty much hit these very dirt expectations, but forward guidance is never good on these things, and it's very shaky on what the next thing is going to happen. So this is why we saw some big rips, and then there's been some massive dips over this past week, especially after that massive rip on JPM. It just came crashing down. Things don't look good. Things are not looking good because there will be more tightening. Even though if we get a cut, you have to understand, and something I've touched on before is that even though we start cutting interest rates, that doesn't mean everything's better. That means things are actually way worse, first of all. And second of all, banks aren't going to lend when people don't have work. And so people are depleting their savings. And the one thing I've talked about, one of the biggest wealth things of wealth that families own is their house. And we haven't seen a massive supply. But one thing we have seen it over the past week was that the average age for owning a home has jumped, I believe, from 35 to like 49. So a lot of younger people are selling their homes because they can't afford it. Either one losing their job or whatever the case is, and so they're selling assets because of that fact. So with that being said, uh, that pretty much wraps up what went on Friday as far as banks are concerned. There wasn't any really no big surprises there. There is some really rocky roads ahead. But what is interesting is we have a lot of regional banks this week. So this is going to be a real prime week before we even get into big tech or any of the other industries, because we are going to be looking at regional banks essentially all this week. We're going to start. Monday is off, and then you have to understand we have all regional banks this week, and we do have semiconductors on Thursday as well. But this will be the news to see what banks go under this week. We start out with Goldman Sachs on Tuesday. Monday, the market is closed. So we start with Goldman Sachs, PNC, I believe, are some of the ones that are left. And then a bunch of regional banks. And so, again, this is going to be a very watching for headlines essentially all this week. We don't really have anything else going on. We do have the Beige Book, I believe, coming out on Wednesday, which we'll get to that further down. So again, this week's going to be very important to be watching headline news, because we want to see, we've lost a bank on every earnings. We want to see what banks go under this time around. And if there's a multiple banks is the concern, because we are getting on essentially the precipice of something big is going to happen with the banks. I have to also understand that regulations for the banks and their holdings are going to change on March, around the same time period around when we are expecting the cut. And so that's what I'm saying. There's a lot of really important dates that are highlighted around that March time period that have to be addressed. In banks' holdings, essentially, they have to hold so much before they can start lending out. They can't just start like, since the pandemic, they've pretty much been able to just lend whatever, and they don't have to have any reserves. But now that's all changing here in March. And so we have to keep that in mind when a potential, pricing in a recession and potential rate cuts. Now you have to be very mindful, because even if they drop the rates and inflation starts coming back, guess what? Guess what's going to happen from that point? From that point, they're going to have to start raising rates back up. So we have to be very careful. And that's why I said, even though the CPI this week was important, it's going to be more important when we start cutting rates in the CPI. If it starts to rise even more quicker and faster, that's going to be a huge issue. Again, we've seen this back in the 70s. So Let's get back into some of the other weekly recap stuff here. But as far as the banks, again, this week's going to be big. This past week is just we just kind of got a taste of some of the big banks, like I said, with JPM, Wells Fargo, BlackRock. They spewed a lot of interesting information as well, because this past week we've also had the spot Bitcoin ETF approval, which is something we were waiting on, and we've got a lot of false starts throughout the past couple months, and then we got a false start the day before approval. And this is what is really strange: is a quote unquote they were hacked, right? And there's no way Gary Gensler's account got hacked. How could it get hacked? There's no way. Like, he's this right? He's the sec. So how? There's no way. Like, security is prime on point. To say that he got hacked is essentially a fake news in my opinion. But with that being said, we did finally get approval, and they weren't just going to approve one; they approved all of them, because ARK was supposed to get approved on the 10th. And again, they're not just going to favor one person. If they approve one, they're going to approve them all, and that's exactly what happened. The following day, I thought maybe they would have tried to delay it, but there's some really key takeaways. Not only once the approval happens, so you had the hack the day before, then you had the approval, then you had Gary Gensler come out and say, even before the hack, that he wasn't all about it yet. He was one of the people that actually voted for it. And then the day of, when it actually was approved, he still came out and said he still has concerns about it, which led, and this is tying into the banks, which led Vanguard to say they are not listing a Bitcoin ETF. And then you had Bank of America come right back after that and say they are not don't want anything to do with Bitcoin either. So you do have two huge a bank, and then you also have a huge Vanguard being another one of them that is this essentially blatantly came out and said that they don't want anything to do with Bitcoin or crypto. And you had Gensler still talking about it. Now, this is on the same token, in the same breath. You also have someone like the CEO of JPM, right, Jamie Dimon, and him saying that he doesn't believe in it. He thinks it's corrupt when it comes to crypto. Yet they're filing for a spot ETF, I believe, or they have the infrastructure for it and something he's signed off on it. So again, there's a lot of misleading information when it's going around crypto. But one of my biggest concerns is that it started to sell off, and sell off heavily. Bitcoin started to sell off, and we started to see this affect other different stocks. So like your typical stocks, like your Riot or your coin that you were buying before, essentially all those were liquidated. So there's massive selling, people pulling money out of there and putting it into these ETFs. And again, if you know anything about crypto, it defeats the whole purpose of crypto having a ETF, because it centralizes crypto, and that's not what crypto was essentially established for. Essentially established for having peer-to-peer trading and not having middleman, like these banks, to essentially charge you fees for something. And so this is why it was extremely important that you try to buy as much crypto before something like this happen. And as that window will essentially diminish more and more over the next couple of years before they really lock it down. Because once they start really putting a lot of regulation, I don't believe we're going to see these huge spikes like people, they're saying the base case. This is something else, is they start coming out with base cases around like at least 250, or base case, like 1 million. And so you're getting all these crazy numbers. It's almost like it does seem, again, I don't want to call it scammy, but it does seem very scammy that you got these high numbers. So essentially all you would have to do is just go buy crypto and you're set for life. Right. And this is not the way things work. And you also had BlackRock, I believe it was the BlackRock CEO, come out and essentially say that it's looked at as an asset class. It's not an actually currency. And so with that being said, it's more so looked at like gold, the digital gold. Right. And I've compared it many times like that and said that this is essentially what it would be like. Although with the technology, it's not like gold, because you can do a lot more. Even with currency, right? This is why they're establishing a CBDC, essentially their version of a digital currency, because they're not going to, they don't want people to buy into Bitcoin, right, or any kind of crypto. So anyway, it was at least in one sense a good acknowledgement to crypto, but also on the same token makes it more legitimate now that there's an ETF. But also again, understand it essentially diminishes what it stands for and what it was designed for. So again, very interesting to see how that plays out. So the next couple of months with crypto is going to be very interesting on what happens. But ultimately, yes, I still believe crypto and AI will lead this bump out of here and this massive push up once we price in a recession. Something I've talked about multiple times is I do believe a recession needs to be priced in, whether that's making a new low or whether that's just another heavy dip before that happens. But one thing, like I stated, is I think this is the dip you need to be buying, whatever levels. This is why I do supply and demand, because I buy at the levels. And then I think it's again very important to uh, be very specific on which ones that you want and can do very well. And so I mean those ones that hopefully have both crypto and they have AI or just one or the other. Again, in my opinion, is where I think this is the beginning of this year. I think is going to be the dip buy portion of it. And then towards the back half could get pretty interesting. So especially going in an election year. So that was a spot ETF, and then you had also core CPI, which is starting to rise again, which again is very concerning. Like any kind of um, inflation, you have to understand that it shifts around, and so these are essentially the top five. So car insurance has been going up like crazy. Transportation is still 10%. Car repair inflation is at 7.1. Rent inflation is still very high, and homeowner inflation is still very high. Insurance has just been killing everybody, even despite them saying that it's only like 30%. There was a 30% drop, like one of the other inflations. I think it was like inflation reports ago. There is no way, because insurance is one of the highest things, especially when you look at, again, car insurance has been out of control, and people have been. This is why the Fed have been talking about like services is very hard to get in control of when it comes to inflation, because once they move those prices up, they don't like coming back down. And so again, paying an arm and a leg just to drive a vehicle right now is ridiculous. So and it was again the same issue that we had with rent before, but rent is coming down. Home ownership, HOA fees, right? All these fees are starting. There was massive issues when it comes to inflation there. So again, still something we're fighting. The 2% targets where it's at. Again, I think the Fed will overshoot this. And I think again we're still going to see. I think they were aiming. Projections did come out as well, and I think the projection is essentially showing that we would hit a 2% target, like maybe in 2026, I believe it was, but we still got like 2 more years for us to really hit that. So there's still going to be a lot of volatility and a lot of issues, and especially again once we make that cut, if for some reason demand comes back, inflation is going to start rising again, and that's going to cause another big issue. So we do have to be very careful on that moving forward. So definitely see how that comes. Upcoming week, like I said, Monday market is closed. It's Martin Luther King Day. Wednesday we have the Beige Book. So we don't have any major events coming up this week. The Beige Book is just more insight. Again, we have another monetary policy at the end of the month. I think there's like a 93% chance they aren't doing anything, and I would agree with that. I think January is just too soon for them to do any kind of cutting. But we have been surprised by the Fed. They did that the last monetary policy when they essentially talked about all these rate cuts to pump it back up, only to walk back their statements the day after through some of the other Fed members. So again, you take it with a grain of salt. And again, they're going to have mixed messages because they don't want people front running anything. So just keep that in mind. So the Beige Book, again, will let us inside the next monetary policy. But again, I don't really see a lot happening there. But again, I didn't see a lot happening when Powell came out in the last one, and then he got very dovish, and again, I'm talking about a lot of rate cuts. So that is January 30th for that monetary policy, and then we're going to have a gap, like I stated, till March, which I think March would be the time if they're going to cut there. If they don't cut there, and maybe more reliant on some emergency cuts, or maybe they'll announce a cut there just to kind of ease things that would price in a recession. and then go from that point. Again, we will see, but that's what we're aiming for is March 20th. Core. Again, we're going to have a core every month, obviously. The next one is until the 13th. Upcoming earnings this week. So Tuesday, we do have Goldman Sachs, Morgan Stanley, and PNC Bank. And then, like I said, we have chips on Thursday. So those are some of the big ones I'm highlighting. Again, every time we do earnings, I always state this. I highlight the big ones that I am watching. There are tons of earnings going on. So you definitely want to be watching. There's also a lot of Fed members talking this week, so keep that in mind. They like to always pump up the market. Again, they do that before they have essentially monetary policy, because the week after there's going to be a blackout period before they have monetary policy. There's always a blackout period before monetary policy, so you don't see any Fed members. So before they go into that blackout period, you get this week, which is a full week of a lot of Fed members talking what their opinion is, and it really doesn't matter. Powell's opinion is the only one that matters. But you get a lot of opinion, you get a lot of volatility from some of these members, especially, some of them hold a lot more weight. And so with that being said, you will see some volatility this week just from the Fed members speaking as well, on top of whatever news may be coming out. And then obviously we have these numbers here. I haven't updated these. I will update these on the website later today as well. So, but that's pretty much that. Let's jump that back up to here. I know last time I had to make 2 separate videos, so I'm hoping not to have to make 2 separate videos here. So let's check out these charts here now. So again, we are very, very close. We're only 16 points away from all-time high on SPX. It wants to hit that all-time high. Again, we will see what happens. It keeps getting rejected pretty hard. I'm almost thinking it would. I thought it would have already hit all-time high on SPX, as most things have already hit all-time highs, but it's having a very hard trouble trying to hit all-time high on SPX. So we'll have to see what happens. But nonetheless, we are very close here. Like I talked about, this parabolic move, this is normal just before a cut. And then once that cut is priced in, then again, you get your price in a recession. And this is something I want to point out when we're talking about, when you're looking at this chart, it's very easy to understand when someone's explaining it to you, that's exactly what's going on. We hit a very critical level here, and that's exactly when they paused. Because if we would have broke that, we would definitely made new lows. And so again, very parabolic. When you have parabolic up like this, it's always step up and elevator down. So the fact that you have essentially shoot up, you're going to have one hell of an elevator down. So just keep that in mind when it does happen, because it will happen at some point. When they price in that first rate cut, we will price in a recession. And then from that point, you want to be buying in that price in a recession, and then going into the boom cycle, which we start turning on the printer again. So again, we'll watch this level. Again, once we break that all-time high, it's kind of just a free-for-all. That's why it's interesting to see that. And something I talked about coming into this run up is that, back when we started stalling out back in, what was it? Coming into 2022, we were hitting all-time highs, and we started getting that pullback down to the 3,600. Every time we hit a new all-time highs, we would essentially wick, and then we would only stay in there for like an hour. So I'm kind of thinking that may be what happens. Even though if we do break an all-time high, that would at least give the presidency or administration, hey, we hit all-time high, and then it wicked down and then sold off for price in a recession, right? Strong possibility. And so so that's what's interesting there. So we'll see what happens this battle here. I'm not really looking at the upside. Again, we've had this parabolic move. Again, we still have a long time before that March period. We could continue to go up higher. In my opinion, I don't see earnings being strong, so it's hard for me to really see it go up. They need more positive news for it to go up. Market always goes up if there's no bad news. So unless we start really, again, you are coming into regional bank news, so you may lose a lot of banks. Depending on how many banks we lose, it could get pretty bad very quickly. So that's one thing you need to keep in mind. And again, just because we have specific dates on monetary policy doesn't mean they can come out and start cutting right away. And dispute, very mindful of that. But that's what I keep trying to emphasize. When they start cutting, when you hear headlines, the Fed are cutting, that's when you need to get ready to start buying, because we were going to price in a recession at that point. that it doesn't have to fall in line. We're just going off what we currently know. But when you hear that in the headlines, that is your cue to you turn on your money printer, start buying, getting up financial advice. But on these massive pullbacks that we will get from that, again, I'm not saying it's just going to crash. You have to understand a lot of the things that we're in a very historical time period. And I've been talking about this for the past year. The numbers you are seeing are not normal numbers, they're very historical numbers, and you're getting bigger moves. Right. And you have to understand when we price in a recession, they could take a couple months, like 2 months of just solid selling off. And just buying that dip, right? That could be what happens. We don't know. Maybe it's a quick flash crash. You need to be buying, right? Because this is the last one. As soon as this is priced in, and again, depending on what that event is that it causes it to sell off, it could be this week because of banks. We don't know. More layoffs, I believe, a lot more layoffs. The longer we have higher rates, the more layoffs we're going to get. So those are things you have to keep in mind, and this is why you have to be adjustable. You can't be black and white, because that is not black and white at all. It's very emotional, and people get very emotional because you're dealing with money. And then you have to be emotionless, and you have to be smart about what's going on. And again, this is something I keep talking about. This is what we've waited for. Cycles always play out. They're not. They always say they're not exact. They rhyme. But again, just be prepared, because that's what could potentially start happening here. And again, these levels I'm watching, the 4,600 mark here, the $4,300 mark, and then ultimately breaking that 41 would essentially put us in the range to start talking about a new low, which people are thinking 3,200. You have to understand that we are in national debt. Like, the Fed is in debt to the Treasury, like billions of dollars right now, which it's never been. Even the financial crisis of 2008, we have never been negative billions of dollars. Never. That is something you need to keep an eye on, because that could mean that we could get very, very bad, very, very nasty, very quickly, and that there won't be any news. And I talked about this when we started wicking, when we had this first drop, when we hit it, for no reason at all, it's going to just start selling. And you have to have a plan. And as I said, if you're prepared to buy the dips, not just buy on the first dip, but let it pull back and just keep buying and buying and buying. Especially, you should already have a list of the ones that you want to have ready for what's about to happen. You should have generated that list over the past 6 months. You should be ready, and when that essentially that pin is pulled, you are ready to pull the trigger on your buys, right? So we will continue to watch this and see what happens, but it'd be interesting to see. Like I said, I don't want to stay on this too long. Again, it could, once it breaks up, we don't know where it's going to go from that point. It's pretty much an price discovery at that point, so we don't know if it's going to keep going up or not. But as far as the news is concerned, there really isn't a great enough news for it to just keep going until we price in a recession. So that is your cue. Until we price in a recession, we're going to go up no matter what. So we may just continue to grind until that does happen. So Bitcoin, I talked about this. Once we got the approval, we had some heavy selling. I really think this thing is going to pull back. I would hope at least to the 30K mark. We will really see. Once we press in recession, I do believe that Bitcoin is not exclusive at this point. Bitcoin is like every other asset out there, and it will pull back like everything. I think people that are afraid of what's currently going on have bought in, and that's kind of what you've seen to this point, aside with the hype of the Bitcoin spot ETF. So we've had a lot of money come in, but again, also understand that from this point, we're not going to make, I don't believe we're going to go all-time highs as of right now. Like, we have to price in that recession. That has to happen for us to really be in a bull market. We've been in a short-term push up, but I don't believe we're in a new bull cycle yet. We need to price in that recession. We've talked about rolling recessions that we're currently been going on through, which is, some people are expecting it not to, that when the recession actually hits, which really isn't reported to like a year and a half after the fact, that it's going to it may not be as bad. So we may not see a new low. We don't know. This is why when it starts to sell, you just need to start buying on those ones that they have at good levels and make sure you have your list ready. So we'll see what happens there. These are some of the spot ETFs. This is one of ARK, so it came out. It started flushing pretty hard. HODL is another one. Same thing. It starts selling off pretty hard. Even bonds here have been pulling back quite a bit. We will continue to watch and see how bonds do. I don't really talk about bonds a lot, but bonds play huge into everything that's currently going on. So did see quite a bit of a parabolic back in October, was really the bottom. I think this is just a pullback, healthy pullback, maybe to the 80s, 88, and then start ripping back up. But I think bonds will start recovering from this point, in my opinion. I think at this point it's just going to be a higher low. And so we'll see how that does play out. Gold in itself, again, I don't really talk about gold. It's trying to break out to new highs, but again, heavily manipulated, so you really can't count on gold. And my concern for Bitcoin is that it will be heavily manipulated as well, that we're not going to see any $1 million Bitcoin. And that's not saying it can't happen, but I think a lot of things need to play out for something like that to occur. Potentially, it could happen. This is why you got to diversify kind of in different investments, right? Because I think crypto is a different type of investment than stocks and bonds, right? So with that being said, it's another kind of asset class that I think you should have in your portfolio. Because of that fact is we don't know if it's going to rip up or not. But I don't think it should be all in one or the other. Again, it's just my opinion. It's not financial advice, but. And so we take a look at Tesla. Tesla's been selling off heavy. There's there's all kinds of stuff going on with Elon. Elon's kind of the target man right now. People don't like that he's essentially opening up X to pretty much be an open forum. And so he essentially catches a lot of heat for that. So we'll see what happens here. But they were talking about him doing drugs and stuff this week. So this is why I kind of started to sell off. And then also just the way things are in general with Tesla, and cars are hurting bad. EVs are hurting bad. And the sad thing is Tesla gets mixed in there, even though Tesla's been doing good. They've been doing price reductions. They're trying to move metal. Essentially, where a lot of other car companies are trying to hold on to these high prices that they were selling for a year. You can't do that. Like, you need to continue to move cars, or else you're going to be stuck with a lot full. And a lot of these are delinquencies, and these lots have tons of cars that just aren't selling because people can't afford those either. Because of a lot of hidden expenses. You buy these vehicles, again, as something I talk about with housing and with automobiles, people just look for the monthly price and that's it. And they forget about insurance, which is extremely high right now. Forget about a lot of aspects like HOA fees and stuff like that, right? Like, these are hidden expenses that you're not aware of that are skyrocketing. So you just aim for that price of like, oh, I can afford that. And then you forget about, oh, well, I got all these additional expenses that I didn't know about before I bought the vehicle or I bought the home. And then you own that home for a couple months and you realize, man, I can't afford this. So that's what's happening. And so anyway, so Tesla's selling off. I'd like this to hit about 200. Start, in my opinion, again, not financial advice, but around that 200, I'll start getting buying positions, and especially around these particular areas. I think Tesla could reattempt to try to go for 100. It's hard to really tell. Like I said, everything's about timing. Once Tesla hits a bottom and it starts consolidating, that would be my cue just to buy. So I'm kind of looking for that. I think this thing will at least hit 200, maybe 150. I think there's still a possibility we could go to 100. Again, it all depends on timing. But Tesla's good about that. It will sell off, and then essentially it will consolidate. And normally that's a solid base. And if it dips any lower below that, normally you have to have a bigger event for something like that to happen, which, if you know a recession is priced in, very well could happen. But we don't know for sure. So watching this level, the 200, again, it's been selling off heavy. Normally we get pretty heavy sell-offs like this. That's a good sign. That's normally when you want to be buying Tesla, when you get heavy sell-offs. And Tesla reports in about 2 weeks, and you're getting the selling before even it's reporting. So that's telling you a lot. So when you see price action like this before earnings cycle, that's not normal. So just be prepared. And then if Tesla's one of the ones you want to buy, those are the good levels. Palantir, another good one I want to continue to buy. Hopefully it drops below 14, maybe gets back to 10. It would be fantastic. But this is one I want to buy at these levels at 14, at 10. Maybe if it gets back down below 8, I don't know. When we start pricing a recession, maybe we did see bottoms a year ago for tech. I'm not really sure, but we'll definitely have to see it. It's not saying we won't still have a decent pullback now, but maybe that was the bottom a year ago. It's hard to tell aside from what's currently going on. So for that, and then we also have take a look at Apple real quick, just because Apple is a big front runner. Actually, Microsoft took the lead on the most valuable company over Apple because Apple's been fumbling the bag and hasn't been doing so great lately. And people are kind of tired of the same phones. But anyway, so you're seeing some heavy pullbacks. We'll continue to watch to see how this does. I'm not expecting great earnings from them. But again, for me to start buying in, this thing needs to start getting closer to 150. The closer to 150, the more like Apple. So I'll continue to watch that there. Again, it holds a lot of weight on the index. So if it starts selling off, it could mean bad things for Apple. BA, again, another big one here. They've had major issues with their planes falling apart. Surprise, surprise. If you know anything about Boeing planes, they always fall apart and they always have crashes like this. So, but it's been selling heavy. So again, really watching this 176 level. It could break this 216 mark and start feeling this little gap here down to the 200. So this thing may start selling off again. It's a good value indicator where the market is. So if it keeps selling off, it could be a big problem to try to keep the market propped up. And then, like I stated, we've had JPM, which reported earnings, has skyrocketed, only be knocked right back down within this range. So looking for it to break the 166 and then watch that level at 155. And then the other level here at 141. So expecting at least a pullback to 141. But we'll see there. Bank of America. Again, same thing is it's kind of breaking back down. It did gap fill, so expecting this to actually probably I don't got any lines for this one to start turning and selling back off, probably down to got that level, but I see this actually hitting lower levels back down here to the $25. I think we're going to get a healthy pullback, and it's not even earnings aren't even over yet. They're just getting started, and we're selling off, so that should be concerning leading into that February time period, March time period, where I think we may see some heavy corrections around there. Again, it's normal correction territory, so again, that's where we want to be buying in. So really focusing on that. The beginning of the year, and then again, I think we will have it might be a slow grind back up to the back half of the year, but I think 2025 is the back half of this year into 2025. I think are going to be some big years for the stock market. I think the rest of when you're talking about again, the housing market's still going to play out and still get wrecked and wreak havoc. The automobile industry, I think, is still going to be doing bad this year. But we'll be recovering with everything else towards the back half of this year, next year. But prices, we need a hard reset on pricing, and to be able to do that, you're going to have to sustain that. So again, we're going to have to wait and see what happens here. But I think things are going to get pretty nasty. A lot more people losing their jobs is definitely something that's going to happen. Long as rates are high, even if they do let off on rates, they're still going to keep them high for the remainder of the year. They're only expecting 3 quarter cuts, which will put us, I think, in a 4 or something. So even still, again, if inflation starts coming back, that's going to be a big problem because that means we're going to have to start increasing rates again. So I think this year is going to be a lot of emergency rate cuts, emergency rate increases. But again, all we really care about for the stock market is just one cut, price in a recession, and then we will grind our way back up. And I think that's what's going to happen. So, get ready for it, because when the money printer turns on, stocks are going to go crazy. So if you made it this far, go ahead and drop a thumbs up, and I'll see you guys on the next one.